Jay Meisler, here, February 7th, 2014, current time 11:30 GMT, and here we are in the wait for non-farm payroll and U.S. employment. Market is still smarting from yesterday's whipsaw where Draghi shocked the markets. I say shocked most more, but what he didn't say than what he did say. Market was expecting a dovish press conference, and when he didn't come through, it was forced to run for cover. We saw Eurodollar get up to 136.20 yesterday, which was a resistance level I pointed out on GVI Forex before the fact. It held there, came back down today to 135.50, which is actually 50% of yesterday's range. So 135.50 is going to set the tone today. One thing to keep in mind is that we've traded 135 for 5 days in a row coming into today. We can't rule out that it won't be tested again today, but it really depends on non-farm payroll and what happens with that 135.50 level. If you look at a daily chart, to me the trend line is most important around 136.56. Unless we take that out, we'll maintain a bearish bias. As I said, really the question is how many positions are caught underwater and whether they're looking for a better non-farm payroll to buy a dip. Look at the 4-hour chart. We broke this trend line yesterday. Comes in currently around 135.43, which was around the low following the initial spike on yesterday's Draghi press conference. So, a potential support, but it's going to be lower once a lower level once the press conference. Once the non-farm payroll comes out in about 2 hours. And if you look at the 1 hour, we're between the 100-period moving average and the 200-period moving average, and they're both sloping up. And that's where it comes right down. If you look at non-farm payroll odds, you figure there's going to be a revision to December. If it's not, that would be significant. But there are three things to watch. You got the headline, you got the revisions, and the benchmark revisions for 2013. So market tends to react to the headline, but you also have to watch the revisions. January is a tricky one because I believe the survey came out during a period when there was not a big weather effect, although the rest of January for the most part was horrible in a good part of the United States. So that could actually skew the number back up a little bit for those looking for a weather effect, but this is a hard one to call because of the weather, and as usual with a large margin of error subject to revision. So to sum it up, between 135.50, 135, 136, 135 sets the tone to take this market higher. You'd have to get above 136. On the downside, you'd have to get below 135, which is traded 5 days in a row, and then below the week's low at 134.75. So this is where we stand right now. Normally, on non-farm payroll, you'll see dollar yen have the purest reaction. It looks like it's trying to get a bid now, and then that would 102 is going to determine where that currency goes. Longer term, people are still bullish on dollar yen, maybe a little less after this correction, but people are still calling it for the most part higher during this year. So that's it. Watch out for non-farm payroll. Keep your seatbelts on. Play it close to the vest until the dust settles, and we'll see you on GVI.